All right, let's talk about Upland Software. We just had their Q2 2025 earnings call, and it was a fascinating one. This is a perfect example of a company telling one story, and the market hearing something completely different. Management was talking about a big win, a major milestone, but the stock got absolutely crushed. So let's get into it and figure out what's really going on here.
So, on one side of the ring, you have management, with the CEO on the call celebrating what he called a meaningful milestone, getting the core of their business back to growth. And on the other side, you have the market, which delivered a pretty brutal knockout punch, sending the stock down over 15.5% in a single day. This huge disconnect is what we're going to unpack. Why the huge difference of opinion?
To get to the bottom of this, we've got to start where most investors do, with the big headline numbers. These are the figures that flashed across trading screens and set the tone for the day.
First up, the bottom line, earnings per share. Upland came in 3 cents short of what analysts were expecting. Now, in the grand scheme of things, that's not a disaster. But in this kind of market, it's definitely strike one. Then you look at the top line, their revenue. And hey, they actually squeaked out a tiny beat. So you're thinking, okay, a small miss on earnings, a small beat on revenue, it's kind of a wash, right? Well, not so fast. Because the next number is the one that really sent a chill down Wall Street's spine.
And here it is, 23%. Despite that tiny beat against estimates, their revenue was down a staggering 23% from the same time last year. For a software company, seeing your revenue shrink by almost a quarter, well, that's a massive flashing red light for investors, no matter how you try to explain it.
So, when you put it all together on the scorecard, you really see the conflict. You've got the earnings miss, you've got that huge revenue drop, but then there's this one bright spot that management was really hammering on. Their adjusted EBITDA margin expanded by 500 basis points. That's a full 5 percentage points, up to 25%. And that jump in profitability, that's the heart of their entire turnaround story.
So this is where the two narratives just completely split apart. Management is over here shouting, "Look at our profits, we're leaner, we're more efficient." But the market is over there screaming, "We don't care, where's the growth?" And you know, for software stocks, top-line revenue growth is king. It's the name of the game. And here's the CEO, Jack McDonald, basically saying, "Hey, hold on. If you ignore the parts of the business we're intentionally selling off, the core part that we're keeping is actually growing again." So his argument is that this is all part of the plan. They're just pruning the dying branches so the healthier parts of the tree can finally thrive.
But the market? Well, this chart says it all. The market wasn't buying it, at least not yet. Investors heard that big, scary number, 23% revenue decline, way louder than the nuanced talk about positive core organic growth. The stock just got hammered, plain and simple. All that nuance management was trying to communicate got completely lost in the headlines.
Now, to be fair to Upland, this revenue drop wasn't some kind of accident or sign of collapse. It's actually a deliberate part of a massive strategic pivot they're in the middle of. So let's break down what they're actually trying to accomplish here. It really boils down to 4 key steps. First, divest. They're actively selling off the pieces of their business that aren't very profitable. This is what's causing revenue to drop, but it's also what's making their profit margin shoot up. Second, focus. They're putting all their chips on their AI-powered products. Third, refinance. This is a huge deal. They successfully pushed their debt maturity way out to 2031, which gives them a ton of breathing room. And finally, step 4, profit. Use the cash from this new, leaner business to pay down that debt.
And you've got to give them credit, they are actually doing what they said they would. Since the start of 2024, they've paid down over $240 million in debt. This quarter, they hit that internal core growth milestone they were so excited about. And right after the quarter ended, they locked in that new debt deal. So they're checking the boxes.
So, what is this new focus? It's all about AI, but in a pretty smart way. They're not trying to build the next ChatGPT. Instead, they want to be an enabling technology. Think about the gold rush. They're not mining for gold. They're selling the picks and shovels. Their tools are designed to plug right into the bigger AI systems that large companies are building, making those systems smarter. It's a really clever niche to try and own.
Okay, so that's the grand strategy, but what about the road ahead? Well, the company's guidance and the questions analysts were asking give us a really clear map of what to expect for the rest of the year.
And yep, the guidance pretty much confirms the entire game plan. For the third quarter, they're expecting revenue to be down again, no surprise there, as they continue to sell off assets. But look at that margin number. They're guiding to a massive 32%. That is an incredible 11 percentage point jump from last year. It's the same trade-off, just on steroids. Sacrifice revenue for a huge boost in profitability.
The analysts on the call really honed in on the key issues. First, M&A, off the table. The focus is 100% on paying down debt. The business environment, management says it's fine, and that AI is a real tailwind for them. And maybe the most important takeaway, they actually raised their full-year free cash flow guidance to about $20 million. That's a tangible sign that all the cost-cutting is actually working.
All right, that brings us to the big question. What comes next? It's time to lay out the official Talk Tickers thesis on what to watch for with Upland Software.
So here's what you really need to be watching over the next 3 to 6 months. Number 1, they absolutely have to hit their Q3 numbers, especially that 32% margin target. Number 2, we need to see some real proof that their AI products are selling, like getting traction on the AWS Marketplace. Number 3, that debt level has to keep ticking down. And finally, the big one, they have to prove that this core organic growth wasn't just a one-quarter fluke. It has to be real and sustainable.
Okay, time for the Talk Tickers verdict. Our prediction for Q3 is that they'll probably hit their guidance, maybe even beat it slightly, but for the stock price, we see it stuck in a range, likely between $2 and $2.75. The market is in full-on show-me mode, and it's going to take more than one quarter to win back trust. For that reason, our rating is market perform. The risks of this transition seem pretty well balanced by the potential rewards for now. The question for the next call is simple. Can they finally turn this newfound profitability into a growth story the market actually wants to buy?
And as always, remember, this is not financial advice.